We can leverage our stock positions, our entire portfolio, in fact, to the maximum level. We can borrow money from everyone we know, from our credit cards, cash advance places, and every other means of acquiring more capital because the Fed has my back, right? I mean, if you truly believed what you were doing, you would go 100% into it. You wouldn't just invest some, you would go headfirst, risking it all. But since the Fed has removed the risk part, you're just getting free money, right? You came here for the truth, so let me unveil that for you. This is the topic of today. We want to look at statistically what's happening here, show you the divide between the haves and have-nots, and ask the question, the Fed isn't going to pull a plug, right? I mean, this is what we're doing today. We're looking at the markets going head first, all in, simply because the Federal Reserve is there to backstop any losses. Of course, they have never said that they're doing that, but this is the way that we interpret it. But the question that I ask you as the individual, maybe yourself or people you know or what have you, when you look at an investment, or business or anything like this, you typically would go all in if you really believed it. You wouldn't put $1,000 somewhere when you have $10,000 waiting around because you're kind of unsure. If you were unsure, you wouldn't go with it, or at least you probably shouldn't go with it. If you knew exactly what you were doing, not only would you do the 10,000, you would try to leverage that up as much as you possibly could, because at this point, we're being told there's no risk. And this is the disconnect that I find between people who are investing, between the speculators, the gamblers, between individuals getting into new businesses and so on. You dip your toe in, you're only going to get so much out of it. It's going to work like that. But if you go in all the way, it might hurt more, but also there's more benefit there. So you have to weigh it out and really come to terms with what are you trying to do. Let's get into it right now. Mania in stocks like GameStop, surging options activity suggests a market pullback is coming. The wild rocket higher in GameStop and then its quick fall is a sign of frothy trading that could precede a broader market pullback. Of course, they discuss what happened here with this particular stock. I covered this in a previous video. It's just one example. You do not have to look at this stock to see what's happening in the overall market. You have people who do not know what they're doing, who have gotten into this, and they are now giving others advice. It's really strange because you could see these people who clearly do not know what they're talking about, but they bought in Tesla stock. The Tesla stock has gone up and now they're very intelligent. This isn't the way it works through a cycle. Through a cycle, many underpants are thrown away and new ones needed to be purchased. And that really is the telltale sign of somebody who is unprepared. The underwear index is actually a real thing, nothing to do with the market, of course, but I brought it up on the channel before. This is just something that I like to joke about because people, they don't hedge their bets, they don't make any preparations, and they don't understand what actual diversification is. Diversification isn't a 60-40 split and you think that you're diversified. Oh my goodness, it goes many, many levels deeper than that. I discuss it in both my books as well. If you want some free info, it's available in the playlists on my channel. Let's take it a bit further. We've got this article here, bubble fears everywhere, but all investors can do is keep buying. And that ultimately is what I'm talking about at the beginning of the video here, because they're being told there is no risk. So why not just get into it? Across Wall Street, signs of speculative excess are everywhere. Penny stocks are surging, cash pouring into trendy thematic bets, risky debt paying less than ever with unchecked animal spirits and historic valuations. What's an investor to do? Keep buying, apparently. Exchange traded U.S. equity funds took in $7 billion last week, and I'll show you the chart on that in just a second. The S&P rose 1.9%, its best week since November. Tech shares, dubbed the world's second most crowded trade, hits records again. Of course, they don't really have anywhere else to go but up and up and up, for now at least, until something changes. The trend is clearly up. I'm always, every single day, I see many comments referring to the fact that I am telling you the market's going down, when all I'm doing is just showing you what has happened. And let me do it again, because I know those people don't actually watch the video, so I'm preaching to the choir, but I'm telling you that the market's going up. I'm simply documenting it. That's all this channel is. It's all spurring the likes of Citigroup, JP Morgan to warn of market excess and everything from blank check companies to cryptocurrencies. Yet as fresh stimulus beckons, Wall Street firms are telling money managers to stay largely invested in rallying stock benchmarks. And of course, this is the direction that it will continue to go as long as they're being told there is no more risk. But then we have this. How much do you agree or disagree with the following statement? Quote, currently, there are many bubbles in financial markets. This comes from Deutsche Bank. And you could see right here, the top two by far strongly agree or slightly agree. So we have the vast majority of the investors believing that there are bubbles, whether it's to a strong degree or slight degree. They at least agree with that, the vast majority, and yet the intention here is to keep it going for the time being. And I completely understand why, because they've been conditioned this way. Every time there's a dip of some sort, 5% down, 2% down, whatever it is, it's always surging back higher. It dips down a little further, they go and buy it even higher, and it goes higher and higher and higher throughout this period. And we have some very out of whack indicators today. In fact, many are simply throwing the indicators away, and the price discovery mechanism of the market has now all but disappeared. And that, of course, presents itself as a future danger that will, of course, at some point down the line, become a very big problem. And of course, the bigger they are, the harder they fall. This is the chart. You could see it right here. Investors are pouring cash into equity ETFs last week, despite bubble fears. On the left-hand side, that's equity. And right beside that, you're seeing fixed income, billions and billions of dollars, $7 billion for equity. And that's just a small section of what's been happening over this period. I mean, billions and billions into these ETFs. You're looking at it and all kinds of things really that have been happening into this period. The actual, where they're putting it exactly, that's been changing, certainly. Tech stocks don't. They are definitely leading the pack. Got a couple charts here. The panic euphoria model has gone completely off the charts. This is from 1987 up until the present. We've never seen anything like this before. The 2020 SPAC IPO boom has continued into early 2021 already. So think about it. 2020 was crazy for the SPAC IPO nonsense. And now, today, we are just barely into 2021, and we're already going and accelerating to a point where we're going to blow way past last year. This is absurd. Nobody even knows what these are about. SPAC sounds good to me. Kind of sounds like spam. Hey, that could be good. Let's throw our money in. It's ridiculous. They don't even know what the SPAC has to do with a lot of times. They just throw it in. It's a blank check company, and they go in and buy some stuff, and it goes up a lot of the time because money is just flowing everywhere right now because the interest rates are so low, because the risk indicators are clearly not being looked at, and the Federal Reserve refuses to acknowledge what's happening. They say, no, everything's fine. I don't see any problems here. I don't see any problems here. And of course, they don't want to admit what they're doing, but they know exactly what's going on. Trading in stocks with extremely high EV to sales ratios has surged. Take a look at what's going on. Not quite to the levels we had seen back in 2000, but certainly it will get there. Just give it some time. 39 US stocks trading with EV sales ratios greater than 20 times. I mean, you could see it for yourself. All kinds of companies in this list, whether it's in the IT side, you got software in here. There are all kinds of things, but typically around the technology seems to be definitely one of those big groups. And there are several names. If you're interested, definitely check it out. I just want to show you that we've gone really into absurd territories today. What level of risk do you think you're currently taking in your investments? This is from Bank of America's fund manager survey that I show you regularly. And look, right now today, a record high. And this is just the case because they say, well, this is what I have to do to get that yield, so I'm going to continue to do it. Well, that's up to you if you'd like to do so. I just want to show you and give you an update on it statistically, as well as the surveys, and give you all the information you need to make the right decision. I couldn't believe this. I really couldn't believe this, but I wanted to bring it to you to show you BlackBerry insiders unload shares amid the biggest rally in 21 years. BlackBerry, who I thought they were gone. Okay, I remember the BlackBerry back in the day. This was the in thing. Everybody had a BlackBerry. Every business person had a BlackBerry, and then it started to become more common for people to be carrying it around on the streets for their personal use. I mean, BlackBerry was huge. It was secure and so on. But they lost out, and the stock just got, plummeting down. It got pummeled. It was unbelievable. Now we're looking at it here. And you could see right now, for reasons, you can read into it for yourself. There are no reasons for it as far as I'm concerned, because nobody's using a BlackBerry today. Very, very few people. And they're using Android software. The software which made it was a strong point of that software because it was so secure and so on. Nobody wanted to deal with it because managing the actual server side was more difficult. You needed somebody that knew the technology and so on. Now today it's much, much easier without using this type of thing. They went Android. Things have changed. And, there might be more to it here than that. All I'm showing you is that these companies, which used to be higher, they went down for any particular reason. There are a bunch of people out there that are looking at that and thinking, whoa, wait a second, that means it could go higher. So let's buy into it. And for many of them, they're actually doing this. It's crazy. It's completely out of whack. But that's the kind of market that we're in today. That's all for this video. If you found it informative, hit that thumbs up button. When you do, you're supporting me. I want to thank you for that. If you click that button on your screen, you help me out. Thank you. If you want to learn about e-commerce, you're interested in selling things online, you just want to know what this whole thing is about, this is the free way to do it. I created this course for you as my subscriber to hopefully reduce the amount of hatred towards me on my channel. That absolutely did not work. But hey, you can just take advantage of the free course. Check it out, the AmazonGPS.com. If you want to learn about the financial system, top to bottom, A to Z, I got the 2 books you got to read. Check them out at the link in the description. And if you want the audiobook, it's available at themoneygps.com. But hang on, hold on, don't go anywhere. Have you seen this video yet? A lot of detail. Definitely want to check it out. Click it. I'll see you there.